Of Freaky Fast Home Buyers and Investments, along with our investor relations success manager,
Collin Campbell.
That's the man. New dad right here. I mean, he already is a dad, but just had his third child.
Number 3 added in, had our first daughter.
And she's already got you wrapped around her finger.
Absolutely. Yeah. Yes. Buy her anything, but she doesn't really need much right now. So.
But wait till she turns 16, you know?
We'll start that investment account sometime.
Yeah,
so.
Absolutely. Well, you're listening to Brick by Brick, building generational wealth, one single family house at a time. And I feel like I changed the name of this podcast. Like I add something to it, or the tagline's always a little different. You know, it's
okay.
Brick by Brick.
Yeah, I think the main title is the most important part, right? And you get the visual of the foundation you're building with the bricks. You know, got the basics down. That's what you need.
Well, and you know, it's interesting. It's been a long day at work, and so my brain is fried. You know, we're just looking at deals, underwriting deals. We got the 263 homes in St. Louis. We have the 100 in Cincinnati. We got the gas station deal, 3 gas station deals. I mean, it's just more and more deals are coming across our desk, which is great because it's given us opportunities for us, our investors. And just a lot of great things, and it's interesting with the way the market is right now. Who knows what's going to happen with the rate cuts, and there's supposed to be some more cuts at the end of this year. How much is that really going to affect? You said something kind of interesting today, actually. Yeah. What was that about mortgages?
Yeah, absolutely. You know, I mean, I think just on that general subject, right, like the momentum that we're seeing within the space right now is incredible. The statistic that I heard was essentially when after the Feds cut the rate by a quarter point, which again is not really that crazy, but literally just that single move gave mortgages an upshot of 30%. So applications for mortgages went up 30%, you know, whenever you compare it to last year's numbers at this time. And so that's just showing the buyer confidence that's there in the market at this point. You know, to be able to dive back into the market, get excited about single family homes again.
And when these cuts, you know, continue to go down, you're just going to see it continue to spike.
Yep.
Which is funny because this cut rate really didn't make that much of a difference. But it's just the mindset. It's just kind of what people think, you know. And it's funny, some of the mortgage rates actually had gone down before the Feds made the cut, and then the rate cut, and then in some cases I heard mortgage rates were going up a little bit after it. So it's just funny how that works. But I do think 2 things. One, that's why we're not seeing prices fall in real estate,
right?
Because the buyers are there. It's not that people don't want to buy; they're waiting for rates to come down. And when those rates come down, you're going to just see a mad rush again to real estate. And so that's keeping the prices strong. The second thing that it tells me is there's a lot of money waiting to be deployed, whether it's investors waiting to deploy it or it's first-time home buyers waiting. And I think it's going to just be a mad dash, which is what we've been telling investors for the last 3 years. And it's like, now's the time to invest. Like, invest. There's deals out there. And I think right now we're finding a lot of deals because I think sellers are realizing it's not really a seller's market, even though prices haven't necessarily dropped. It's kind of transitioned to a buyer's market, which is allowing us to find some really good deals that we can then turn around and have available for when the rates do come down.
Yes, absolutely.
And it transitions back to a seller's market. And we here at Freaky Fast win, whether that's us, our investors, whoever's involved with the transactions we're doing. We're setting ourselves up for just a really big opportunity.
Yeah, and I mean, I can't emphasize that enough. You can ever, quote unquote, time the market 100% the right way. But in terms of a real estate investment, you always want to have the opportunity to buy when the time is right and to be able to sell when the time is right. And what we're seeing is obviously you had the heydays of the real estate market back in 2020, 2021, where everything was super hot, tons of transaction volumes that happened. Now you're seeing investment groups like the one that we're purchasing this current deal from right now. They're very motivated to sell because the market has shifted unfavorably for them, right? Which gives us an opportunity to come in to buy, right? And then we're going to hold that for, a few years, and gives us the opportunity when the market is hot again to be able to sell. So you've got to be able to play the market right at the right time as much as possible. And that's really the kind of type of opportunities that we're seeing laid out before us.
100%. And I think a lot of people, they want to wait until the bottom drops to where it's like they've hit rock bottom. Yeah. The problem with that strategy is this: no one knows what rock bottom is.
Absolutely.
So if you're waiting for it to drop, so it's here and it comes down to here, and you're like, oh, it's going to go down some more. Yeah. I'm not going to invest. Well, there's a chance it doesn't. Yep. And there's a chance it maybe just goes up to here or up to here. So it's like you buy, and if it goes down again, you buy again.
Right.
And it goes down again, you buy again.
Yep.
And eventually at some point it'll go up. I'll give you a perfect example, okay? It's a very small example in the sense of money or transaction, but the strategy itself is a perfect example. So you remember Doge?
Yeah.
Okay. Yeah. So I bought some at like 8%, and then sold
you're talking about Dogecoin.
Yeah, Dogecoin.
Oh, sorry. I thought you were talking about the Department of Governmental Efficiency.
Is that even still in existence?
I don't think so.
I think they got fired. Anyways.
Yeah, that's why. Anyway, sorry. Dogecoin.
No, yeah, the Dogecoin. I bought it back in, I think it was 21 for like 8 or 6 cents. Sold it at like 8 or 9 cents.
Okay.
And then it like dropped to like 4 cents, and I didn't buy it, but then it went back up to like 6 or 7 cents. So I bought it again. I bought it. Then it went up to like 20 cents. And I was like, sweet. And then it went up to 30 cents, and it went up to 50 cents. And I'm like, oh, this is great. And I'm buying the whole time it's going up.
Yeah, yeah.
Well, and I'm making money, but then I put like $2,000 in it at 50 cents. And Elon comes on Saturday Night Live, does this little skit, and it plummets, right? Plummets down to 8%. So I literally lost like a couple, 4 or 5 grand in this, right?
Yeah.
So what did I do? I put $100 in and bought at 8%.
Yeah.
And then I bought, and then it went up at 12. It went down to 12. I bought like 100 or whatever. Yeah. Well, then it went down to 8, so I lost more money, right? But then I bought it at 200.
Yeah.
And then I just forgot about it.
Yeah.
But I still had all this Doge. Like, what am I going to do with it, right? Well, Trump wins the election in 24.
Yeah.
And guess what happened? Doge went up to 30 cents. So remember, I lost like 2 grand at 50 cents.
Yeah.
But because I bought so much at 8 cents and 12 cents, that when it went back up to 25% or 25 cents, I made all that money that I lost. So I had broken even, and then I was ahead. So that's the point I'm trying to make. Don't be afraid to invest if it drops. You're like, oh, I'm waiting until it goes all the way down to 8 cents. No, because if it drops again, just buy more. And if it drops again, just buy more. Eventually, it will go back up.
Yeah.
And then you're going to be in a lot better spot.
Yeah, although I will say the crypto market is a little different from the real estate market. But
for sure.
The correlation
I
see for sure.
Yeah.
Yeah. And I think that's a good thought, because in general, that real estate for sure is always going to go up in the long haul, right? And I heard this earlier today, and this is a common saying in the real estate space, right, is the idea that you want to marry the house and date the rate, right? Have you ever heard that term? Marry the house, date the rate. So the idea is we're finding good deals in the pipeline right now, regardless of where the interest rate market currently sits, right? The idea is if you find a good house, a good deal on the market, it makes sense regardless of what the interest rate is most of the time. And you can always date the rate, right? So you have a chance when rates do go down, right? We mentioned earlier that the increase in mortgage applications increased by 30%. Well, 40% of those applications were applications for refinances because people were dating the rate, but they're marrying the house, right? And so I think the idea for us as well is, you want to be able to choose a home. You want to be married to that home because you find it to be a very good and attractive deal. But over time, you can date that rate because you know that is what's going to be the thing that's going to fluctuate over time.
I might give you some pushback on that.
Oh, okay.
Yeah.
Tell me why.
Yeah. So here's the reason for that. That's a strategy that a lot of people teach and a lot of people preach.
Yeah.
But if you actually build out the math in a 30-year AM,
Yeah.
the person who just stays at the rate of, say, 7% or 8% is actually going to pay less money than the person who's constantly refinancing.
Oh, interesting.
Because what happens every time you refinance, the first front load of payments is interest payments. And so if you refinance it, you reset that. So now you're paying more interest. So yeah, you got a better rate, but you are now this is for home buyers,
Yeah.
right?
Okay. Yeah.
As investors, you should always be refinancing because then you're taking out that profit that you made and you're reinvesting that profit.
Yeah.
So if there's an opportunity to refinance and pull equity out, I'm a strong believer in that. Right.
Yeah.
But anyways, that was just kind of interesting. Yeah, just give you a
Yeah.
little pushback on that.
No. Okay.
Some
Okay.
dialogue.
Yeah. No, I appreciate that a lot. Because I mean, obviously, there's so many facets whenever it comes to a real estate investment. You've got to keep all of those aspects in
Well,
mind.
and that's the thing, the difference between the investment and then being a home buyer.
Yeah.
Yeah.
So absolutely.
Maybe we should just edit that out.
Okay.
No.
Yeah. That's fine. We can edit that out then.
I'm messing. Well, one thing that I wanted to talk about, because we're talking about the different markets, is actually different strategies to invest. Right?
Yeah.
So what's interesting to me is this post I saw on Facebook. I'll read the post.
Yeah.
I when I saw it, I shared it to you. I was like, we have to talk about this. And now I lost the post.
It's okay. The substance of the post, from my recollection at this point, is that this accountant is recommending that you invest your Roth IRA, right, 100% in stocks, correct?
No bonds, no target retirement date funds, no money market funds. Use other accounts like your brokerage or pre-tax 401k for those. And you want to maximize compounding in the Roth. Can't rebalance later, or you can rebalance later if needed with no tax impact. What's funny to me when I saw that, it's like, oh, I've got to go read the comments.
Yeah.
And you should read the comments. Some people are like, yeah, and some people are like, no, that's too risky. And I'm just like, oh my goodness, because that's wrong. I do not believe that you should be investing your Roth IRA funds in anything in the market.
Give us your hot take, Jason.
Here's the reason why. If you've got money in a Roth, you need to move that over into a self-directed IRA. Because most of these Roths, most of these people have Roths with, Fidelity or Schwab or whatever.
Yeah.
You need to move those into a self-directed, and you need to buy something, an asset, a business, a company, invest it in private equity, invest it in something that's going to give you larger multiples than what the stocks. And they're saying, yeah, but you can compound the stocks over like a 30-year period, and you put like $2,000-$3,000 in there, and as it grows, and then there's just like this chart, and it's like, you can have $1 million in that one point. Yeah. It's like, yeah, but over a 30-year period, you can invest that money into other strategies, other ways that's going to compound and grow much bigger. And here's the reason why you want to do that. Everything that goes into the Roth is tax-free. So if you invest in something that just compounds over a period of time and you make $1 million and you don't pay any tax on it, good for you. But what if I told you could take that same amount of money and make $5 million and not pay any taxes on it? How much better off would you be, right? So I'm a firm believer that you should have a self-directed Roth IRA or a self-directed Roth 401k, and it is for strictly for investments that will grow. If you're like, hey, I am not a risky guy, or I'm not accredited, then okay, fine, go buy a couple houses.
Yeah.
You can buy houses with your Roth.
Yep.
Those houses will continue to grow in appreciation. It will cash flow, and you'll be able to compound and build at a much faster rate, and you're going to have a bigger equity to show for it.
Yeah. No, and I mean, I can't agree more. I think this is the strategy that I've taken with my IRA at this point. I had the opportunity to roll it over from a former employer, move it into a self-directed Roth IRA, and decided to invest it in our equity fund, right? Because it's got a much bigger equity multiple built in than what you're seeing in the stock market, right? You typically, most people who are like, kind of index set it and forget it folks are going to say, hey, you can bank on 10% a year growth, right? Which is not bad, right? But you look at something like what we're doing, right? We're doing a 2x equity multiple in 3 years, right? That means I'm doubling my money. I'm getting 100% return in 3 years versus a 30% maybe return from the stock market, And I'm getting to do all of that absolutely tax-free because it's in a Roth IRA for me. And so I 100% agree with you that the Roth IRA should be something that's built for growth, which to an extent is, to give you again a little bit of pushback, what I think the heart of his post was like, put it in stocks, because in the most people's minds, stocks are the most high growth thing that they can be exposed to.
Yep.
Right. But he's just not thinking about it from an alternative investment point of view.
Sure. And it's interesting to feed off what you're just saying, to piggyback off that. It's interesting how everyone has different opinions or limited knowledge.
Yes.
They know their niche. Mm-hmm. So if they're, a financial advisor and they really just know the stock market, they know that niche.
Yeah.
And so anything outside of that is risky to them. Because they don't know it. Mm-hmm. And then there's some people that they know the alternative investment and they think the stock market's risky. Like me, for example, I have very limited amount of capital in the stock market. Mm-hmm. Why? Because I think the stock market can be risky in a lot of ways. I also feel like for the amount of returns the stock market gives, it's like, no, I'd rather invest that in myself, invest that in my company, invest that into things that are going to generate cash flow, or quick equity. To me, money in the stock market is money that's like, okay, you got 6 months of life savings, for a rainy day. Maybe put that into like a high earning savings account, or invest that into a money market account that's making a little bit of money for you, so the money's just not like sitting in a savings account not making anything.
Right.
But to me, unless you just literally want to put your money away and not think about it, and even then, like, buy rental properties, right? So it's funny just how different personalities are, different opinions based off of what they believe or what they do or what they focus on.
Yeah, for sure. And I'll share one other just quick tidbit I heard this morning from the podcast I was listening to, where I got that bit about the 30% increase in mortgage applications. They also shared how there is a large number of people in the United States right now, my generation, the millennial generation, who's banking on getting an inheritance from the baby boomers generation. Now, obviously, the baby boomers hold a ton of equity in their homes, right? Now, the main concern, though, that they were voicing was this. Baby boomers are now living longer, right, than was previously anticipated before. So a lot of people in the baby boomers generation, what they're doing with their mortgages is they're doing reverse mortgages, right? And so they're living off of kind of the equity that they built up over time and turning that into debt, right? So that a lot of people unknowingly may actually be inheriting debt from the baby boomers versus actual equity like they think they're going to be getting, right? And so there's just a large amount of evidence right now that my generation millennials are not putting much money into savings or investments because they're banking on some type of inheritance to come to them, when the actual data suggests we need to be actually doing the work of saving, of investing ourselves, because we can't bank on that like we thought we could.
Well, and those reverse mortgages are so tricky too, and I've only heard nightmare stories on that. And you hit the nail on the head. The money has to be working.
Yeah, absolutely.
Like, the money has to be moving. And what I mean by moving, it's moving out of your bank into something. Unfortunately, I'm in some assets that are sitting. They're not necessarily cash flowing. In some ways, some people might consider them dead money.
Mm-hmm.
But it's not. It's in something that that is generating money. I'm just maybe not seeing anything yet. But then at some point when it sells, I will receive that money and get that money back with a profit.
Yeah.
So for me, it's like just get that money moving. And that means get it out of your hands, get it out of your bank account, get it into something that is going to grow. Yeah. Don't just bury it. And we see that parable in the Bible. You know, here's the talents that you've been given. And I want you to report back to me when I come back. And, you know, the first 2 doubled it. The second not only didn't double it because he buried it, because he didn't want to lose it. He ended up losing it because he couldn't remember where he buried it. And so, you know, it's like it's sometimes fearful money does not make money. But even more so, fearful money loses. So you have to take risk. You know, Tori tells me this all the time when I feel stressed. Money goes and money comes back. You put money out and money will come back to you. Don't be afraid to put it out because it comes back. Yeah. And so you just, going along with what you're saying, you just got to be smart. You got to be investing. You got to be putting money out there and allowing that wealth to be built. And so what's the best way to do that? Well, single-family homes. Invest in single-family homes. Then from there, maybe invest in multifamily. Invest, you know, commercial, you got to be really careful. Like, you got to be niche in commercial these days. You know, these office building spaces, oh, man, I don't know if I'm investing in those. So many people are working from home or co-op, you know, workspaces. But there's good commercial out there. Invest in, you know, businesses and private equity and, you know, other riskier investments. Maybe have that fund money, you know, that you're putting in for the big hit. Go take 50 and put it on Reddit in Vegas. You know, I mean, just live your life.
Or invest it in Dogecoin.
But crypto. Man, you know, that's one that I still am trying to learn is crypto. I'm not even going to pretend that I know.
That's for me, that's the putting it on a red type of mentality that you have to have, you know.
But guys, thank you so much for listening to us ramble. Hopefully we're actually giving good pieces of knowledge, you know, and just a recap of this podcast so you leave with something. Use a Roth. If you're not taking advantage of the Roth, you're making a mistake. Use a Roth. You say, well, I don't have a Roth. Well, first of all, check to see if you have 401k or an IRA. Most likely, if you work a 9 to 5 job, you work for corporate America, you're going to have a 401k or an IRA. Yeah. You know, take advantage of that. Get those into a self-directed. Open up a Roth account. If you don't have one, there's you know, advisors would be like, oh, there's tax implications. Yes, but then there's tax benefits. So and we'll be more than happy to help if you've got questions. But use a Roth and invest in a Roth, and use that Roth to invest in alternative investments.
Absolutely. Take advantage of it. Start building your portfolio. We believe the bedrock of it should be single-family homes to start building that generational wealth brick by brick. I think that's the title, right?
It is. Hey, and brick by brick, if you think about bricklaying, that is hard work. Yeah. It's not easy. Doesn't happen overnight, but you're just laying that foundation. And then one day there's going to be this great brick wall or home that your family is going to be able to appreciate and to inherit because of your hard work. You've been listening to Brick by Brick. I'm Jason.
And I'm Collin.
You guys have a great day.